Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 21st of November 2021. We're still hearing lots of chatter about the stock market crashing imminently, but how likely is that? I think we can all agree that we are in the midst of a huge asset bubble, but where are we in that bubble? And what things can we look out for to signal a top? This chart illustrates the phases of an asset bubble. And as far as stocks go right now, I think we are well and truly in this mania phase here, with significant public involvement over here. But of course, this is quite a large area over here. Where are we within this phase? Well, I'm thinking that we're somewhere between greed and delusion. But my point here is that I don't think we've hit the peak here, and that's the new paradigm phase. So that's where the overwhelming sentiment is that stocks will never stop their relentless rise. This is just the way things are. And I'm just not hearing that enough at the moment. Having said that, using sentiment to try and nail a top is actually very difficult because it's so subjective. Here's the list of some of this kind of psychology that you see at the top. And except for the it's different this time, we're kind of seeing most of all the other ones, aren't we? And so to me, that suggests that we're at least in the vicinity of a top. But of course, the problem is that irrational behavior can go on for a lot longer than many expect. One thing that we do know for sure is that at euphoric market tops, fundamentals just don't matter at all. Therefore, I reckon looking at fundamental parameters like, earnings and P/E ratios and all of that, I think it's pretty pointless at this stage. A lot of those things are very manipulated, but the sentiment basically doesn't care about the fundamentals. That's the crux of it. So the market will consistently defy logic due to irrational euphoria. The other thing that we need to consider is the difference between a melt-up in a market within a stable currency and a crack-up boom where the currency is rapidly losing value and there's loss of faith in the currency itself. So with both of these, the crowd do stampede, but of course the difference is looking at what the currency is doing. And I think probably looking at the gold price may be the best indicator for this. As discussed in my previous video about crack-up booms, here are the features we'd expect to see. And I think there's no doubt that we are in the process of a crack-up boom. But the problem is we don't know how far along we are in that process. One thing I would say is that I don't think that we're in the final stages yet. The gold price hasn't exploded and we're not seeing massive levels of inflation at the consumer levels. Although they are increasing, they're not the levels that you'd see at the top of a crack-up boom. The reason I mention the difference between melt-up and crack-up boom is that melt-ups can occur intermittently within a larger boom. So here's an example of a parabolic stock, and most parabolic moves do exhibit these kind of similar features. So if we zoom in here, if we didn't know what was going on in the future over here, I think you'll agree this move here would look like a melt-up. And then, of course, that was followed by a 70 to 80% drop there. But then notice how price charged up. There was a massive move up here. And again, with this massive green candle here, that could be, well, even this whole move here could be seen as being a melt-up move. And again, that was followed by a large drop, maybe 50% drop. But then again, price charged up again. So we can see multiple melt-ups within a much larger parabolic move. And of course, this could go even further. I mean, let's say, this could drop here and then make an even bigger move. And so we'd have to shrink the chart again to fit that in. And so that's what makes it very difficult to know where we are. Okay, next, let's look at some potential bubble top indicators. Now, I came across this, which is the Sotheby's indicator, and that's the Sotheby's stock price. The rationale here is that art auctions reflect irrational exuberance during market bubbles. And so easy money is spent with exponential flamboyance. We can see here that the Sotheby's peak preceded the Nikkei peak by 3 months. Over here you can see that it was a year early in predicting the Nasdaq peak, and it was spot on for the 2007 S&P 500 peak here. So I'm wondering if this could go higher. Perhaps if we connect these highs here, then this trend line here suggests potential for it to go up to 80, let's say. Now, of course, this is just speculation. All we can say is that we are at the previous highs roughly. So look, we could turn around here because we are at these highs. It's okay to be nervous, but also there is potential room above if we get even more irrational exuberance coming. Here's something that I thought was interesting. So this is the ratio of the S&P 500 to the US 10-year yield. And this goes back to 1980. And I've drawn these trend lines, and each of them has 3 touches. So I joined the low here, 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 and it's almost touching there. It's not quite there. And then I also joined the highs here and here, and that led to a touch over here as well, which was quite interesting. Right now, the ratio is in the midpoint between these 2 trend lines. What I'm wondering is, if this ratio drops below this lower trend line here, would that signify the popping of the stock and bond bubbles? Now, if you think about it, if the ratio were to drop significantly like that down here, what would that mean? Well, I've written down here the circumstances in which this could occur, and there are multiple ones. So one is that stocks could stay stable and the US 10-year yield could go up. Another possibility is that stocks could drop, but the US 10-year stays stable or drops less. Alternatively, stocks could drop and the 10-year yield goes up, or stocks could go up and the US 10-year yield goes up even more. So if you think about it, if you got a large drop in this ratio, then 3 out of 4 of these scenarios here would require a higher 10-year yield, which makes me wonder if that would signify the bursting of the bond bubble. Next, let's look at the S&P 500 to VIX ratio, and that's shown in the bars here. The orange line is the S&P 500. Now, one thing I thought was interesting here is that whenever we had significant market lows, so here, here, and well, this is March 2020 over here, you can see that the S&P 500 to VIX ratio got between 30 and 40 over here. So I thought that was quite interesting. Now, the top trend line is also of interest here. So what I've done here is join these peaks here, and each of these peaks, So the peak here matches with the peak in the S&P 500 here. We've got the peak here, which actually preceded this peak here. So yeah, it was early. And then, of course, what have we got? We've got smaller peaks here, but if we just look at the significant peaks, there's one over here. That one is a bit anomalous because it kind of, I guess it signifies this kind of consolidation area here before things got a lot higher. So yeah, that one's questionable there. So look, I don't know how reliable this top line is. The bottom one does seem not too bad. But look, let's just say that this does mean something. Then we still have a bit more room to go above if that is the case. Now, exuberant as you might think the tech sector is right now, it's actually been even more euphoric in the past. This is the monthly Nasdaq chart on a log scale, and I've drawn the 40-month moving average in blue here. The reason that I chose the 40-month moving average is that during the bull markets here, you can see that it's actually been reasonable support for the whole of the bull market. So below here is the distance from the 40-month moving average. And right now it's sitting here at about 53% above the moving average. You can see here that at the peak of the dot-com bubble, it was over 100% above the moving average. So that makes me think that we haven't reached the peak euphoria that we reached in the dot-com bubble. So perhaps there is still room above. Now, look, there's nothing to say that we have to reach that, but if we're looking for a crash, you kind of need that sentiment at some level. Now, it won't necessarily get as high as that, but this is kind of not too far from average levels for a lot of the time anyway. So I would expect something a bit higher than that at least. If things did get just as euphoric as the dot-com bubble, how high can we expect the Nasdaq to go from here? Well, here what I've done is copied the price bars from here in the early 1990s to here in the 2000 peak. I then moved them across here and kind of stretched and moved things around to try and see if there was any kind of fit to the price action from around 2009. Now, it's interesting, isn't it? Apart from this section here, 2014 to about 2016, you can see that although it's not perfect, the trajectory is surprisingly similar, isn't it? Right now, we are here. Very interesting. Well, look, let's zoom in and let's look at the same chart, but on the weekly scale. So the black line is the Nasdaq price action, and the pink bars are the ones that I copied and pasted there. Now, as I said, getting the fit right on these copied and pasted bars is very subjective. So, you might want to have a go yourself. I don't know if I've done this correctly. And look, it's definitely not perfect, but it's not bad either. So if we were to replicate the dot-com blow-off top, then this chart would suggest a target price of 27,500. Now, I know that seems a bit crazy, a bit far-fetched, and I've got no idea if that's going to happen. It doesn't have to reach that level before dropping. Perhaps another way of looking at it is to draw some channels. So again, this is the Nasdaq chart on the monthly scale and on the log scale. And in blue is the long-term channel that's formed by joining this low here and this low here. And so there's only two touches there. So again, when you've only got two touches, the strength of the line is going to be questionable. And what I've done is move this so we've got a parallel line touching this top here. And again, this has only got one touch, so it's not necessarily, hugely reliable. But this is the midline of the channel, and what we can say right now is that we are well above that midline of this blue channel there. Now, I've also drawn a shorter term channel in this maroon lines here, and I've done that by joining this low here with this low here, and then I've moved it up to join this high here. Now, you might say, oh, why didn't you join these highs here? Well, that's actually where the midline is, if you look at it, and we are above that midline, and so that's why I've done it this way. But again, look, with all of these trend line things, there is subjectivity. Different people will do different things, but this is just one way of looking at it. So overall, we are above the midline of both of these channels. So the big question is, are we going to hit the top of one of these channels? So let's be conservative and look at this maroon one. According to this, if we were to hit the top of this channel sometime in 2022, then that would coincide with a level of around 26 or 27,000, which kind of matches the last chart, doesn't it? Now, of course, remember though, the asymmetry of this trade is rather poor. Okay, so of course, this could maybe just go up a little bit more and then turn around and drop. And the downside here is quite large. I mean, this, if we were to touch this lower trend line, we're talking below 5,000 here. But the way things are, I'm actually doubtful that we'll get that low. What I'm wondering is, say we did get that final spurt of irrational exuberance going up here, and then we got a drop perhaps down to this midline or even down to this midline here. That's still a huge drop if you think about it. We're going from about 26,000 down to, well, back where we are down to about 15,000. Or we could even touch this lower line, lower part of this channel here. But hey, what if they print a whole ton more of currency? We could just turn up and go to this upper trend line here. So and that would be massive. And that could be that hyperinflationary crack up boom phase that we've been talking about. And we're kind of fit because I don't feel like we're in that phase at the moment. And so this would purely be related to currency devaluation. Look, I'm just speculating here. I don't know whether that's going to happen or not. These are just ideas that I'm throwing out here. In conclusion, I think one thing that we all agree on is that we are in a massive stock bubble. An important question is, are we just in a melt-up phase within an ongoing crack-up boom, or is this the final melt-up? I'm actually starting to think it's the former, but look, I'm not sure, and I do remain flexible in my thinking. What do you reckon? Anyway, it's certainly not an easy question to answer, but either way, I think the current bull market still has legs in the short term. Next up, the market update. So let's start with the US dollar index, this time on the weekly scale. So this goes back to 2011. And what I've done here, so the red line was that line that I'd drawn a while back. And that's basically joining these lows with this low here. And that gives us this line. But if you were to ignore that wick here and kind of join this low over here with these lows, then of course you get this line over here. And it's interesting because over here that seemed to bounce between those two. And now I thought that this red line would be significant resistance. It did bounce off once, but actually it burst up through there, which was I wasn't expecting that. The question, of course, is how high is this going to go? And look, I'm not, my bias is still to the downside with this, okay? And so why is that? Well, there's a few reasons. So first of all, roughly in this area here, first of all, we've got this black line here, which suggests we, could go to about 97-ish, according to this. The other thing is, of course, you've got all this price action here, which is going to provide resistance. I mean, we're already at a significant resistance point if you look at all this price here and all of this over here. So that is going to be important. Also, if you look at this, we've retraced pretty much exactly 50% of this move downwards. Now, it could go up to that 61.8% level as well. But I think it might, if it does go higher, I think it will get tangled up most likely at this black line here. So that's kind of as much upside as I'm expecting here. Now, the other interesting thing that you'll note is that over the last week or so as this US dollar index moved upwards, so did gold and silver. And so I haven't got it here, but if you look at the correlation coefficients for gold with the DXY and silver with the DXY, both of them flipped to positive. And if you look historically, it doesn't stay positive for a long time. And so that makes me think again that this might turn around and you'll get back to that negative correlation. But of course, we've got no indication of when that's going to occur, but just something to watch out for there. Okay, so this is the gold priced in the world currency unit. Now, what is the world currency unit? Well, that's basically a basket of GDP weighted currencies of the 20 largest economies in the world. And it's designed in such a way that each unit represents a stable unit of purchasing power. So I thought that was quite an interesting thing. Now, of course, they're using the inflation rate within each country's currency to do this. And so although it says it represents purchasing power, remember that it's likely to be an underestimate, okay? As we all know. Okay, so the interesting thing about this chart though is that we well exceeded the highs from 2011, 2012, which is very different from what we saw in the US dollar. And look, we're way above there. And with this correction here, I've drawn this line to join those highs there, and you can see that we've broken out. Now, this is on the monthly scale, so remember that this candle is not yet complete, but even so, I think the price actually even opened above this level. So unless we have some major catastrophe and price comes all the way back down here and breaks down below this line, which I'm highly doubtful of, I think this is looking good, and it does suggest the beginning of an uptrend. We've got slightly higher lows there and a marginally higher high there. So yeah, I think this is an interesting chart to look at. Now, obviously, it's not going to be very useful because you really want to be looking at gold priced in your own currency. But this is just interesting to, if you're interested in looking at purchasing power. Okay, let's look at gold in US dollars this time. And yeah, price stalled a little bit here, and we're moving back down again, which we were talking about last week. And I think we're going to get some support over here. So we're looking at about 1830-ish. Could even go down to retest this trend line here, but I'm expecting it to do something like this. That's my idea with this. And kind of, it's hard to draw here, but it kind of looks like we've got a kind of curve forming here, doesn't it? So that's my thinking there. And silver priced in US dollars on the daily scale, and we've drawn these channels, and yes, I know I've cut off those wicks above and below. The thing with silver, as you know, it's very, very difficult to be precise because silver is the wild one. It does what it wants and it whipshaws backwards and forwards, whiplashes. So yeah, so this is just a kind of rough guideline here. And silver turned back. It actually turned back before it got to this line here. Anyway, I think we're going to get some support at least here at the if it drops down, I think that's 24 is probably the lowest it will go. And what we're hoping for really is a bounce off of this trend line to resume the upwards move. But 26 is going to be potentially a bit of an issue. 26 and 28 have been the two big numbers that we need to watch out for. And then we have the gold miners. So this is the GDX, and we'd spoken about this gap here, and it's kind of partially filled it, but it's still got a little way to go, and that would fit in with what we're seeing with the gold price. So yeah, just a little bit more before potentially turning around again. But yeah, this is looking good. Higher lows and higher highs, and potentially this head and shoulders bottom here. And if that's the case, then the target would be the height of this. So it will take us up into the kind of 40-ish level, I reckon. Okay, and then finally we've got the junior silver miners. So this is the SILJ on the daily scale. And I've just joined these two lines here, and so maybe that will provide support, or maybe we'll go a little bit lower, potentially down to the 13 level before turning around. But as with silver, it looks like there's not much further of a drop to go before we move around. So it kind of looks like gold might drop a little bit more than silver. That's my kind of feeling with that. Anyway, let's just keep a watch on it. Again, we've got that kind of inverse head and shoulders pattern here, which we'd broken out from, come back, broken back through that neckline. So we do really want to get back up above 14. Right, so that's it for the technical analysis. Now, obviously, for many of us, certainly something that's been on my mind for a while is where can we go? Where can we go to be left alone and just get on with our lives? And, you know, I'd kind of been making a list, and as time goes by, I keep having to cross the places off because something's changed. New things have been introduced. And so that list is getting very, very, very short. So where do we go? So obviously I scoured various things on the internet to try and find it. And now I've kind of made a bit of a short list. So here we go. So there was one suggestion here, and the best place to go where you can do whatever you want to do is Davos. Now, of course, I think that's only going to work if you're a member of the club, which I'm not. So I'm going to have to cross that one off the list. Okay, another option is just to get a boat and move around. You know, if things are going to keep changing, then we need to keep changing and be flexible and move around and, you know, just have all your stuff on a boat, which is sounding quite attractive. The only problem for me is that I get pretty badly seasick, and, you know, I would require one of those mega super yachts for the stability on the ocean, really, and it would have to be a big yacht. Of course, that's way out of my budget, and, you know, one of those little piddly little boats, not going to work for me. I'll suffer more on the boat. And so where else is there? What else can we do? Mars. So yeah, there's no rules or restrictions. You could pretty much do what you like, I guess. The only advice I would give, though, if you're thinking of going there, is make sure you don't take any journalists, definitely no politicians, basically no narcissistic sociopaths. The minute you get one of those there, you're screwed. Okay. Anyone else got any other ideas? We're scraping the bottom of the barrel here right now. It's interesting, isn't it? The last couple of years, I found that it's been very good for separating the wheat from the chaff. The problem is there's a hell of a lot of chaff out there. Oh dear. Anyway, that's it from me. Don't forget, I'm also available on Odysee. There's no ads and you get rewards for watching. So I've put the link in the description if you're interested to take a look at my videos over there as well. Anyway, hope you have a nice week. All the best. See you next week. Bye.